We're truly covering all corners of the world today between the four of us. That's nice. An unholy hour for Mike, but you're quite used to doing this now, Mike, right?
Oh, yes. Well, I'm honored to be speaking to you, listening to you. I learn a lot, so I appreciate it.
Oh, that's very kind of you. Okay. Right. I think it's time to start. Very good afternoon from Singapore, and welcome to the Gulf Intelligence Daily Energy Markets webinar. I am Vandana Hari, founder and CEO of Vanda Insights, and today's guest host. Warm welcome to my guests today. We have Mike McGlone, Senior Macro Strategist with Bloomberg Intelligence, Neil Atkinson, former Head of Oil Markets Division at the International Energy Agency, and Mukesh Sehdev, Senior VP, Head of Downstream and Oil Trading at Rystad Energy. Mukesh is making a debut on this program, so welcome to all three of you. A quick look at what has happened over the past 24 hours or so. Crude continues to lose ground today. Brent, August futures trading around 75.78 as we speak, WTI around 71.23. You'd be hard put to find any good news to perk up markets. China's May trade data was released this morning in Asia, and it was disappointing. Exports last month fell 7.5% year on year, quite a reversal from an 8.5% jump in April. The EIA left its 2023 global supply-demand balance forecast mostly unchanged in the latest outlook report that was released yesterday. The World Bank yesterday made a small upgrade to its 2023 global GDP growth expectations from 1.7% in Jan to 2.1% now. But otherwise, that entire report is quite gloomy as well. The bank notes that advanced economies are going to experience the lowest growth in 5 decades this year. And the bank also points out that the poorest countries are being the hardest hit by high interest rates, so not looking good. Let's stay with the theme of interest rates, and clearly the Fed is central to it. So, Mike, I'd like to start with you. The Fed meets in a week's time. There has been quite a lot of back and forth in market expectations over what it will do with rates at this meeting. But also, of course, there is a lot of speculation on what might happen after that. So can you pass the situation for us? And, how should oil market stakeholders be looking at this event?
Yes, I appreciate you pointing out the current trajectories, Vandana, and they're all very bearish, mostly bearish economically on a global scale. And let's look at the Fed. For the next meeting on June 14th, the Fed funds futures on my WIRP function and terminal shows that they might, 20% chance that they might raise another 25 basis points. But as we get to the July meeting, it looks like it's 50% chance that they'll raise 25 in those two meetings. And that's the key point. The Fed still has its button on the takeaway liquidity machine. And that to me is the bottom line. They're still taking away liquidity from the system, the world's most significant central bank, and tilt in most markets is downward, particularly in energy. The US stock market's had its bounce in this environment, but I think what it is a bear market bounce. And I don't see really much upside until typically what it takes in this case is for the Fed to be well into an easing cycle and be adding liquidity to the system. So I think the current trajectory is very bearish. I think it continues. I think crude oil follows the path of natural gas and goes to its cost of production in the US, which is around $50 a barrel. I don't see it getting above 90 and it's stuck at 70 right now. We're seeing the latest cat and mouse game between OPEC and the macro. The macro is the Fed is still tightening. And you've heard me say that last time. I just need to point that out. But OPEC, I think, is doing what's typical in a bear market, what they usually do. They cut supply as they see that demand declining. The biggest risk, I think, is most projections are for demand to increase. That's usually where markets make, players make their money is betting against things like that. And I still expect the biggest risk is markets go down, the U.S. tilts into recession. And that's the current trajectory. And on many measures, one thing is the yield curve still pointing to, just like crude oil in the U.S. and natural gas is pointing to that pretty severe recession. I'll end with this. Our economist expects that to really start kicking in and showing up in July, August.
Right. Okay. Thanks for that. Neil, we've had a fair bit of discussion over the weekend's OPEC Plus meetings, but I just feel there's so much more that one can unpack from this, and I'd love to take this opportunity of having you at the table to get what is your take from everything, the outcome, or including what did not come out of the meeting, and especially the unilateral Saudi cut, which seems to have had absolutely no impact, if the desired impact was to prop up prices. What do you make of what happened over the weekend in Vienna?
Well, Mike's not exactly cheered us up first thing this morning, but and I'm not sure I can add much.
Not his fault.
Well, he's very consistent. I've heard him many times on this show, and he's been pretty consistent, particularly when we go through towards the outlook for crude prices. He's been consistently pretty bearish. And I'm starting to agree with him. Well, okay, the weekend. The Saudi voluntary cut, the 1 million barrels a day for July, depends how you phrase this. It's done nothing to boost prices. That's certainly true. But I don't think they really expected that it would. I think what it's done is to help secure prices roughly where they currently are. And that seems to be the case now. We're on Wednesday morning here. Prices are a little different from what they were when they went into the psychodramatic weekend meeting. So, I've thought for some time, moving on from what Mike was saying about the big macro picture of weakness, I believe for some time, and I've said it on many occasions, that I believe that the global oil demand growth forecasts put out by people like the IEA and the OPEC Secretariat and others are way overcooked. I believe that for some time now. We are not going to see 2 million barrels a day plus of oil demand growth year on year. And we're starting to see, as we move into towards the end of the first half of the year, we were discussing offline earlier on about the weakness in diesel in various markets. Diesel, it's described as the workhorse of the economy. Diesel is used in every application, most applications we can think of, transport, industrial uses, and so on. And the numbers are just not supportive of a big year-on-year growth in global oil demand. Mike was talking about the US interest rate outlook. Here in Europe, we've been promised more interest rate increases by Madame Lagarde from the ECB. The Bank of England in the UK is following the same path. So what the Saudis did at the weekend, I think, was just a question of holding the fort. It's a question of holding the fort. And they couldn't do anything else other than that. And we move on, the circus moves on. The OPEC seminar takes place in the first few days of July. There's not a formal OPEC ministerial meeting as such, but they will all be there. And it is quite possible they'll make further adjustments then. And finally, they will micromanage during the rest of the year as they see fit.
Okay, interesting perspective. Thanks for that, Neil. Mukesh, would you please weigh in as well on the diesel part of the equation as far as demand is concerned, and sort of broaden it out for us, if you will, to refining margins in general, because they've been in the doldrums, haven't they, almost since April. What are some of the key factors influencing the downstream and the refining margins that you would sort of lay out for us for the rest of this year, or if you want to go out into 2024, that's good too.
Okay, no, thank you, everyone. My take is that if you look from a pandemic recovery of products, right, diesel recovered probably the fastest in 2021. Quite a lot recovery took place. Gasoline recovery was second in the chain, and by 23 end, probably gasoline will be fully recovered as well. Jet demand is where probably we have a challenge, as the international sector stagnates around 80 to 90%, and jet demand recovers in 2024. So on a broad perspective, I feel diesel recovered fast. Now, when we look from month to month volatilities and situations, I think clearly diesel is suffering from some seasonal demand drops in the US from 4.1 levels to, we project by July to go down to 3.7, and then seasonally the demand should come back. So the other aspect was around the Russian refining system, which overproduced, and the European refining system kind of bought in panic and accumulated stocks. Meanwhile, the refineries in China, India, particularly, and Middle East started ramping up to capture the Russian diesel loss. So I think that, to me, diesel is more of a supply-driven kind of a challenge rather than a demand-driven sort of a challenge. And if I may, at some point of time, I would like to weigh on my views on the OPEC situation, but I'll preserve that for later. In terms of refinery margins, Vandana, I see that our reference points have changed. So the margins have corrected. But if you look at Asia, the key products cracks are still in $15 per barrel range. If you look at Europe, they are in 20s. If you look at US, they are in 20-25. So, and we must not forget that now we have VLSFO, which was part of the fuel oil pre-pandemic. So we have jet, diesel, gasoline, and VLSFO, a fourth product also performing. So I think it's the reference point problem rather than really margin kind of a doldrum situation.
Okay, interesting. Thanks for that, Mukesh. Mike, coming back to you, we saw a tepid response from the US administration to the Saudi unilateral cut. If I remember correctly, I think an administration official said we are looking at prices, not barrels, something to that effect. At the same time, analysts are pointing out that if Saudi Arabia continues to try and put a floor under prices, wherever that is, 75 or 70, it's going to be difficult for the US to refill the SPR. Do you agree?
No, if you include liquid fuel production from US and Canada, on average, it's exceeding consumption by about 4 million barrels a day, which implies that's net surplus can refill the SPR, the 220 million barrels they took out of the SPR in a couple months. That's how the world's changed. That's part of the reason I'm bearish crude oil, bearish natural gas, bearish most commodities, with the exception of gold, is the supply and demand dynamics. The SPR is no longer significantly needed. In the days of the 70s, when I was a gas jockey, when it was needed, it's really needed only for hurricanes. There's a massive excess of supply in North America, liquid fuels. I say liquid fuels because I do have a farm background. You have to include biofuels.
Sorry to interject, Mike. Sorry, you say it's needed only for hurricanes, but would we be playing that down? Isn't that a huge need? I mean, hurricanes can shut off upwards of 4 million barrels per day of refining capacity in the Gulf Coast. So, and 2 million barrels per day of offshore production. So what are we missing here? Or are you saying it's just a political thing, the pressure that is coming to bear on the Biden administration to refill?
I did enjoy writing a piece that Mr. Biden seemed to be a very good crude oil trader. And he did something very prudent. It was probably political, but from an inventory management standpoint, when you sell inventory into backwardation, that's very prudent. You buy it back into that backwardation as it switches to contango. It's very prudent. So far, that's the key thing. It's not about the mismatch in the U.S. being the world's largest importer, not right now. The world's largest exporter of LNG and the net export of energy is what's shifted in energy. And as the U.S. tilts towards recession, that's the key fact I've been saying about crude oil. It's a bear market. We know that. We see it right now. It's down 40% on a one-year basis, and trying to pick a bottom in that bear market is what OPEC's trying to stabilize. But OPEC is not hurting the U.S. It's hurting its clients, its customers, and that's not the U.S. anymore. The U.S. being a net exporter, it's actually helping what's happening in this major energy transmogrification in the U.S. So that's the macro that people need to get. The bigger picture that really matters, though, for the price of crude oil is this cat and mouse game between the stock market and the Fed. Every time the stock market goes up, Fed rate hike expectations rise, which means there's only going to be a lose when we get a correction downward in the stock market. Basically, for crude oil to stay at the current price, to stabilize, the stock market needs to keep going up. And it looks like it's going to at some point tilt over to a bear market recession, which I fully expect. What commodities typically do after they swing the pendulum way too expensive just a year ago, they usually swing way too cheap within a year or two. And that's already happened in natural gas. It's happened in lumber. And I think it's that domino effect that's kicking in.
Right. Bearish in all capitals. Got that. Neil, Europe, and to some extent, I would say the rest of the world, heaved a sigh of relief that the energy crisis of last year did not worsen over the past winter. But, we continue to hear how Russian pipeline gas supplies to Europe continue to drop. I think they are close to about a tenth of the pre-war volumes now. Correct me if I'm wrong there. How well do you think Europe is positioned with its energy security in the short to medium term?
Well, the biggest single factor which helped the Europeans withstand the consequences of sanctions against Russia and following the invasion was a warm winter. If we'd had a really freezing winter starting early, carrying on through most of the season, the picture would have been very different. And because of the mild winter we had last year, the stocks emerged from the winter season at relatively high levels compared to long-term averages, and the Europeans have been gradually refilling as we move through the spring, and we're now into the summer period. And if the current fill rate continues, the expectations are that when the winter heating season kicks off roughly in October, that Europe will be in a pretty good position. But that will depend on the severity of the winter heating season 23-24. So yeah, I think overall they've done a pretty good job. It is quite incredible how a crisis can force governments or encourage governments to actually get off their hind quarters, sorry, this is a family show, and achieve something really quickly, like the Germans, for example, installing LNG infrastructure very, very fast indeed. So I think the Europeans have handled it pretty well so far, given the severity of the sanctions against Russia and the cutoff of supplies. And they're well placed this winter to at least be in a position to have plenty of natural gas, assuming we don't have a really, really tough winter season. And that's the weather is the we're even worse at forecasting the weather than we are oil prices, or is it the other way around? I'm not sure. So the weather is the key.
Yeah, but looking a little beyond the 23-24 winter, Neil. So would you say that then effectively Europe has successfully weaned itself off Russian gas?
Well, not necessarily, because of course there are plenty of other people out there that want gas. They want LNG from the US, they want LNG from Qatar and Australia, Indonesia, Malaysia, other countries who have plans to expand their LNG infrastructure. And the problem is that Europe can at the moment it can outbid a lot of other prospective purchasers of LNG. We've seen problems in countries such as Pakistan, for example, which had a major switch towards LNG over the last decade, also found itself kicked out of the market because of those rich Europeans. So it's not as if Europe has solved its problem. It hasn't. The issue we're facing is, will there be enough availability of, for example, additional LNG supplies in the next few years to allow the developing countries, particularly in Asia, for whom demand is increasing structurally because of the continued growth in their economies, and also allow at the same time Europe to continue to maintain the supplies it needs for its industry and for winter heating. So it's not a question of solving the crisis, it's a question of adapting as we go along. So far, they've managed to do a pretty good job, aided by the weather.
Yeah, and as you say, to some extent, it could be at the expense of the more price-sensitive LNG importers in Asia. Mukesh, I do want to give you a chance to weigh in on your response to OPEC Plus decisions. Go ahead.
No, I think interesting. Mike is bearish for a different reason. My take is that we live in the world where data transparency is very hard now. Russia stopped publishing China's data, and now there is a lot of conjectures raised on the EIA data as well. So within that context, right, my assessment is that if you look at the supply side of the equation, right, it's clearly that supply is increasing. If we add up only the countries where increase is happening in 23, that number is roughly around 2.6 million barrels per day. The US somewhere around, I would say 800, and EIA just revised their numbers from 600 to a growth of 720. And typically shale also comes back and does a surprise in the second half. It may not be a big one, but I don't think it will be a small one. Brazil is growing, Venezuela is adding 100, Norway has added a lot of, so 2.6 increase in supply. Now that is countered by a negative number of 1.2 or 1.3, which is a combination of all the OPEC countries. Now, if you take the reported data, and if you take the demand side of the equation, which in my mind is not that horribly bad, we are in a much better year than previous years. So demand is probably not the culprit. But when we look at the reported numbers, the balances of whether it is our balances or anybody's balances, they will look very bullish, right? But my gut feel is that there is an underreporting of supply data within the OPEC and the non-transparent world. And that's why they took 6 hours of deliberations on baselines on agreement. So I think from a balances point of view, based on the reported data, I do agree that our balances are bullish, and we have an outlook of, oil hovering around 90s as we go into the third and the fourth quarter. But I think there is some element of, we have to watch, the supply might come more actually than reported because of underreporting and the dark trade kind of the world we are in.
Okay,
and
so
that's
you're
why OPEC has taken action to kind of come with this kind of a cut because probably they know inside more than anybody outside.
So your $90 outlook is predicated on OPEC continuing to tighten if there is a renewed downward pressure on prices?
I think so. I do believe that this is not given the underreporting and the supply continuing to come out. I believe that this cuts will probably roll over, and Saudis would want to stay in control of the market, keep the backwardation as much as they can. I have seen the contango world by staying in Houston for 6 years. So I think Saudis will try to keep that way.
Yeah, okay. Let's have the survey question here. The likely impact of the Fed's rate decision next week and Jay Powell's policy signals, the market will be listening very closely to those as well, on crude prices will be bullish, bearish, or neutral. Have your say. And that's a nice segue for me for my next question to Mike. So there is, Mike, there is this question of what the Fed does next week. And as you were just saying, June and July, it may continue to raise rates is what the market is thinking. But isn't there been a debate in the market, or rather a bet, that if there is a danger of a recession, and as soon as the Fed spots it, it will back off? So that's the whole pivot party that had been going on since late last year. Are you discounting that in your sort of bearish scenario?
Well, I've been bearish for too long, I have to admit that. But no, it's. I wouldn't say I'm discounting it. This is the big dichotomy right now. The market's price for the Fed to start easing by the end of this year as we tilt towards the recession. Yet the Fed says they won't be doing that, and most economists said they won't be easing. And that's the issue. What my economist Anna Wong pointed out is their model showed the Fed should start easing soon, but they can't, because the key things they watch are very sticky inflation measures and personal consumption expenditures, employment cost index. You look at things like owner's equivalent rent and CPI, they're very sticky and very lagging. They're going to stay high despite the fact that we're tilting towards this recession. So that's the lose-lose for all risk assets. And it's the stated goal of the Fed to increase unemployment. Unemployment in the US is the lowest since 1968. And virtually every time that happens, we get a recession. Also, one thing that's happened is we've only had 2 times in history, and the Bloomberg Commodity Index is down about what it is now on a 12-month basis. That's 30%. And both times was a significant recession, 1981 and 2008 and 9. Yet that's the key point is, and the rule, and we all know in markets, is don't fight the Fed. The fact that we're still saying that after we started hiking over a year ago, and as we tilt towards recession, is where my base case for a severe global US economic reset, which is going to drag the rest of the world down, is my base case. And that's the key point, is the Fed is still tightening. And I think here's the key thing I'll leave you with, is that it's unlikely they're going to start easing until markets make them, which means going lower.
Okay, so sometime in 2024, you would say?
Who knows exactly when? It's dependent on the market. And bottom line right now is what's keeping them stalwart to keep rising rates is the stock market. It's being led by the NASDAQ. Now, if that was to tilt downward, they would flip the Fed. So that's the key trigger. And right now it's that cat and mouse game. That's the key point I like to make is every time the stock market goes up, it's more bearish for itself because it keeps the Fed tight. And then as we tilt over to this recession. So I say a year from now, the key thing we're going to be talking about is severe deflationary forces.
Yeah, a cat and mouse game indeed. Neil, a couple of key outcomes from the OPEC meeting was African members, prominently Nigeria and Angola, are now facing the prospect of taking a big cut in their baselines or quotas, however you want to see it. Of course, it's all still to be bolted down. And Russia has been asked to be more transparent about its production, and effectively, as one of our guests was saying yesterday, a couple of guests on yesterday's show, that effectively that means that Russia will now have to deliver on its promised 500,000 barrel per day cut. Do you foresee tensions ahead within OPEC Plus as a result of all these upheavals?
Well, sure. As far as Russia's concerned, I mean, if you seriously believe they're suddenly going to become more transparent and truthful and publish lovely, nice data like we get from the US and other countries, forget it. That's just not going to happen. Russia's interest is solely to keep as much revenue as it possibly can for itself, and that means selling loads more oil as much as they can to India and anybody else that will take it. And Russia is essentially out for itself. And in its current situation, I don't think you can expect anything else. The West African countries that you were talking about earlier, who at one point allegedly were always threatening to go on strike, as far as OPEC was concerned. Yeah, the problem is it's the old saying about, when the tide goes out, you see who's swimming naked. And with the West African countries, with what we're seeing is that they cannot produce even the quotas that they've currently got. And an adjustment was necessary. I don't think it's hugely significant because I added up the combined production from Angola, Congo, Equatorial Guinea, Gabon, and Nigeria, and it's about 2.6 million barrels a day, which is 11% of OPEC production, and it's only 6% of OPEC plus production. So in volume terms, it doesn't really matter that much. But of course, in terms of the cohesion of OPEC, and keeping as many members as they can, however small they may be, that of course is very important for them. So yeah, there are stresses and strains. There will be in the rest of this year, but there always have been. Don't forget, the Iran-Iraq war went on for nearly a decade. You had the Iraqi invasion of Kuwait, various other incidents, and somehow or other, the organization managed to remain largely intact. And I suspect it'll ride through this one as well, but not without stresses and strains and complaints.
Very true. Thanks for that. Shall we have the survey result? And I'd like to then give Mukesh the final say. The likely impact will be neutral or bearish, kind of split between that. Okay, interesting. Mukesh, a little bit sort of taking a few steps back. From the here and now. So we saw a major slump in global refining capacity over 2019 to roughly 2022. And thereafter, and now we are in the midst of a spurt from roughly second half of last year, and which may last till 2025. There's a whole bunch of greenfield projects that are coming up. Do you think these will be the last wave of new refineries that the world will see? And if that is the case, do you think we will be all right after that without any new building?
No, good question. And I think without complicating the answer, my answer is that indeed, the way we know refining for ages, that's really probably the last wave. And this wave was essentially triggered by a time when everybody was saying diesel is king and gasoline is dead. I remember those times. And that sparked a lot of the hydrocracking and diesel-driven capacity in Middle East and a number of countries. So the way we know refining as we go forward and in our scenarios, as gasoline and diesel demand declines, there is no way the rest of the products can pull up and provide the incentive to the market. Petrochemical demand is going to stay strong. Jet demand is still going to be strong. We will still need the fuel oil for the ships. But the main products, gasoline and diesel, if that declines, there is no way refining can sustain. Our assessment in the most aggressive scenario could be that as much as 40% of the refining capacity doesn't need to exist from a road transport perspective. But then I believe...
By when?
By 2050. By 2050, yeah, I'm taking a longer term picture now. Sorry, yeah
sure.
By 2050. So that means that we will still need naphtha, we will still need jet, and refining system has to really go a bit of a technological revolution from becoming the bottom of the barrel upgrader to maybe now the top of the barrel upgrader, and the future crude oil of choice will likely not be the heavier and the medium sour barrels, but maybe the lighter US shale kind of barrels. So I think certainly capacity reductions, closures, conversions would be a major thing going forward, particularly in the US and in the European. Yes, we will have news here and there of some refinery being announced, like we had in the US recently, but I don't think that refineries need 20 years of cash flow to justify. Refineries don't have the runway left to build projects and earn the money back as we have known refining. So big shift in refining is certainly on our way.
Okay, interesting. And with that, we have run out of time. So please join me in thanking my guests today, Mike, Neil, and Mukesh. Thank you very much. We have a halftime talk with Michal Maidan. It's up on your screens. Go take a look as and when you have time. And with that, thank you very much. Have a great day and rest of the week ahead. Thank you. Bye-bye.